Here we go. Look, if you want to find ways to improve your business, your contracting business, and if you're curious, you're looking around to find ways for running your contracting company like an actual company. And if you want to work smarter, not just harder, then you're in the right place. Welcome to the Profit Tool Belt podcast. This show is all about tips and tricks and shortcuts that other business owners are using, that they're learning on this show about how to get their business moving forward or to the next level, as you might say. Do you want to solve the frustration you feel in the areas of your business of time, team, money, growth, sales, marketing? Are you in a family business? Are you solo in business? Do you have business partners? Do you do residential work? Do you do commercial work? Do you do civil work? We answer all of those questions here on the Profit Tool Belt podcast, where we only talk about the business of the construction business. There is a difference between being a contractor with a crew and a business person who just happens to be a contractor. Today's guest is David Hern, and I brought him in specifically to talk about what would my construction business sell for. Now, I met David when one of my clients, who has a residential service company, they do doors, had to get a valuation on the business because there's a succession plan. So succession plan means one of the kids is taken over from the parents. That's a common type of succession plan. In order to do that, they had to have a value, they had to strike a value for the business. And to do that, you call a guy like David Hern. So I thought, I wonder if he'd be a good guest for the show. And it turns out, I think he's going to be great. So let's see the world through his eyes. I want you to see what you can learn about the opportunities in front of you and maybe the challenges about selling your business one day in the future. Can you find nuggets of wisdom, something you can take away for your business? And so I'm going to, as I always do, I'm going to throw out a coaching challenge for you today. I want you to listen very carefully about what David has to say about how to organize your company, what you need to start doing today, and the mistakes your competitors all around you are making. And of course, you don't want to make those mistakes, right? But David's going to outline them for us here on this episode. So think about how you put those in place in your business. And what would the impact be if you put them in place? What would it look like? And what would it look like if you didn't? If you just continued knowing you had a problem but didn't solve it, how much would that hurt your heart? Anyways, that's why I put the coaching challenge out there, because I want you to take action. Look, David's going to share something today. I might say something today, but that one thing could be $1,000 change in your business. It might be $1,000 a day change in your business, which multiplied by 250 working days is quite a big impact on your business. That's what you've got to go look for. You have to pull that kind of value out of this episode. We're going to put it in front of you, but you've got to find those little opportunities because they're in here. David's very experienced on business valuations. I'm experienced on business coaching and business turnarounds, specifically in construction and contracting. So you're going to find something, but it's up to you to take that and run with it. Anyways, let's get to it. Mr. David Hern, how are you?
I'm better than I deserve. How are you?
You probably deserve to be as good as you are. Wait, is that right? How do I answer that? I'm real good.
Good.
Yeah, probably a lot like you. I get to do what I love, and I love doing it.
Hey, never work a day in your life, then.
Yeah, I think your naturally positive attitude is how you and I met, actually.
I would tend to agree. Yes.
Yeah.
We met through entrepreneur circles and mutual friends.
Yeah. Well, I had a burning need. One of my clients, they install garage doors and passage doors. They needed to get a valuation on their business. It's a family business, transferring from parents to son. And that's one of the applications for why you need to get a dollar value on your business. It's not always selling. And so I was looking around for somebody in their area, and your name popped up with a bunch of people saying, you got to talk to David Hern.
Yes, this tends to be a usual problem in a good way with us, which is wonderful. No better introduction than a warm one. So
yeah, no kidding.
Yeah, we're very humbled on the network and how we get brought to our fine clients.
Yeah. Well, listen, today you and I are going to talk about something that you're obviously an expert in, and which is what would my business sell for anyway? But before we get to all that, David Hern, who the heck are you? And how is it you come to be speaking to all these forward-facing business owners in construction all around the world?
Sure. Yeah. A little bit, personally and professionally. Yeah. I'm a father of three.
Mm.
I reside in the suburbs of Atlanta, Georgia, and married my college sweetheart.
Oh,
We
nice.
are both byproducts of the fine university in Georgia Tech here in Atlanta. And we have three kids. So I'm a proud parent. Occasionally we foster, so sometimes we have a few more.
Oh,
So
wow.
kids are kind of our platform from a philanthropic and where I put my time and energy from a board and that kind of perspective. But
Yeah.
so we always have a busy household. So if you ever come over, it's chaos.
I bet a little
But
bit of chaos and a full fridge or an empty fridge.
oh, well, I dare not say, but there might be more than one fridge. In case there's any environmentalists going to listen to this, but we
Yeah.
do.
Yeah.
Professionally, yeah, after university, I started my career as a CPA. I got my designation, and I joke sometimes these days I feel like that stands for can't pass again or certified pain in the you know what.
Oh, yeah. Yeah.
Um,
Yeah. Yeah.
but
Yeah.
so I was a former tax accountant recovering, and
Tax accountant. You've got way too much personality to be a tax accountant. And by the way, I am speaking to all the tax accountants out there, of which there is probably just you on the show. So,
I mean, between being an extrovert and a technologist, yeah, go figure how I would go to such a fine engineering school and end up an accountant.
yeah, no kidding.
But I did. And it turns out it was a very, it's funny how when you look back at your career, how different places, help and inform where you end up next. But I have a very big pivot away from accounting and into more finance,
Mm.
for the rest of my career, where I went into investment banking. And
Oh,
while there, we really only did two things. We either sold companies or we raised capital for folks, and valued really three things. Um, I was shocked at just how often my colleagues who were only in finance their whole career would come to me with accounting questions that made an impact on banks they were covering or
yeah.
banks they were valuing and so on. So it proved a very useful base as made this migration.
It,
Um,
yeah, it's funny you say that. And I know we might be jumping ahead a little bit, but can I impact the value that my business will sell for just by organizing my books in a certain way?
Short answer, absolutely.
Yeah. Well, a lot of people don't think that though. They think the numbers is the numbers, but you guys are magicians at making the numbers, go to the right column in the right way so that you get the most on sale day.
100%. Yeah. So we tend to see this story of, well, do you want the books or do you want the tax books? and when we're selling, there's no longer a need for conservatism. A lot of times we're having to make adjustments in order to really discern, this
Mm-hmm.
company, what is true earnings for this company. So if I'm an acquirer, the way I'm going to get my return is on that cash flow, that those distributions.
Yeah.
And so what is true earnings? And that's part of the hard part is making sure the books present that fairly.
Again, I know I'm jumping ahead, but if I came to you today with my operating business, yeah, I'm jumping way ahead. But I do need to know this. Maybe it sets the stage for this conversation. Of course, we're not going to mention the name of the company that you and I met through one of my clients who needed to value their company. But how long does it take to get your books moved from, we've got our books running great for, mitigating taxes to getting our books over to a place where they're set up best to sell for maximum value?
So this would be that famous professional services, it depends, that you're going to hear.
Okay.
Usually, probably your attorney hits you with that the most, but
Yeah.
it really does, right? Because now we have to ask ourselves, well, how many years, how many businesses? Because a lot of companies have multiple, divisions that maybe track
Right.
under, different financials, and so that's tough to answer. But I would tell you, in the normal course of, let's just say, a more simple business that's one consolidated set of financials, we tend to see valuations themselves be, anywhere from a 3 week to 3 month process. And even when you hit go to say, okay, I'm ready to list, I'm ready to get buyers in the door. Once you've got, sufficient interest, again, typically a transaction, once you decide who you're going to go exclusive with, again, these things are normally done in 60 to 90 days. So in my experience, most of the time when it comes to accounting cleanup, again, usually, we're hoping to accomplish that in at least a quarter cycle, to keep things progressing.
Mm. I feel like I've taken us off the game here. I've jumped towards the end. So sorry about that, but thank you.
Sure.
Let's go back.
Questions are good.
Let's go back, and we're gonna talk today. What would my construction business sell for anyway? What do we need to have as a basic level of understanding for people here on the show, and they're all owners of construction businesses, to understand how to get to this point where they get the value of their business? How much would this thing sell for? That's a really fuzzy topic, and I think people get frustrated that there's no number. But how does a guy like you tease that apart?
Often we find very few businesses of any kind, not just construction focused, are one tool that they could be using as a management team is having an annual, or at least every 2 years, but some type of frequency of their own assessment. Because when there is a buyer for your business, and inevitably there always will be people, contacting you, whether, financial type buyers like private equity or other, competitors and friends in the space, they're going to be having their own valuations done on your business. And so it would be very astute to have yours ready and know at any given point in a year, like where you stand, and are you truly tracking to what we call transferable value or sellable value, which is very different than what a lot of companies operate as. A lot of times they're lifestyle businesses and these kind of things. So it's a common recommendation of us that they should best practice would be to have some type of evaluation performed annually, whether internally or externally, to again make sure they're growing in the direction that they're seeking to grow.
How often do you hear people coming to you going, "Isn't this just an easy answer? Isn't it 2 times revenue or 2 times profit or 4 times?" Or, in dream world, 10 times, I want 10 times my revenues for a sale price. Isn't there just an easy number you could peg and say, yep, that's exactly what it's going to sell for?
So I laugh because the word simple on almost, I'd say probably 2/3 or more of our calls comes up where
I know, I hear it too. That's why I said it. Yeah.
I mean, either the business owner thinks their business is super simple, and sometimes we even see small businesses that say they should be easy because they're small, and inherently, because of the question you already asked about books, they're actually more difficult because their books aren't as accurate and their team isn't as filled out. So a couple things there, because the first part of your question is really about what I would call rules of thumb, that either they've heard about or that their, friends have sold for, where there's some industry norm. The problem with the rules of thumb, first of all of the major valuation, credentials and organizations all basically say you can't rely on them. And the reason they say that is because those rules of thumbs change on some frequency, because what else is changing? The business themselves is changing. They're within a microcosm of an industry, which also can change, which is in a microcosm of the economy, which can also change in any given month or year. I mean, you can't turn on a news outlet right now and not hear the dreaded R question or R word. So, so that's partly why you shouldn't just say, okay, we hear businesses like ours sell for 2 times. So, if we've got an offer for 2, that seems fair. And it's like, well, maybe not, right? Because I can tell you valuations were quite elevated the last few years through COVID. And now there's been some softening. So that's a big reason why you don't want to just rely on a rule of thumb, is you have a high degree of potentially underselling because that rule of thumb has changed on you.
I was really hoping for an easy answer.
I wish I could give it.
Yeah, so does everybody else listening. They're like, come on, man, just give me an easy answer. So let's do this then. When you look at a construction company, and let's not say it's a general contractor who's using a lot of subs. Let's say that we're actually talking to one of the subcontractors, the person that has the truck that loads the materials, that drives to the job site to do the work, or has a manufacturing facility where they might be building things out of sheet metal or wood or various other products. What are the components that go into figuring out the sale price?
So great question. It's very akin to, how do you value a company? Like what tools are available to do that? There are three main approaches to try and discern what a potential, fair market value or sale price might be. One is what's called a cost or asset approach. It sounds a lot like a balance sheet. Like if I could really discern it in one simple, equation, it's value equals assets minus liabilities. It's as simple as that, which looks a lot like a balance sheet, right? Your balance sheet shows your assets, shows your liabilities. So that what's left over, that's your shareholders' equity. Businesses that are a startup or are in a lot of turmoil, like meaning they are at risk of closing and shuttering, or very asset intensive businesses, those are the types of companies that would typically be valued on a cost or asset approach. So in our experience, that's kind of a more of a rarer method that people would use. More often, to value a company and discern what's a fair sale price, you're living in two other approaches. And one, it kind of comes from the real estate world, which is a market approach. In other words, I'm going to figure out my value of my house by looking at the value of other houses that look like mine right down the road, right? So we're going to run comps.
Yeah.
Right. And so then what you're going to do is kind of come up with, well, okay, I live in, Atlanta, Georgia. The price per square foot for similar properties is X dollars. So I'm going to apply that market rate to my square footage. Well, we do a similar thing with businesses and construction companies. We're going to look at other construction companies who've sold and go, well, what are they selling for? What are their multiples? But what you're going to see when you see that is a very wide range of multiples, even in the recent past. And so that's
because the factors are different. Yeah, the variables are different, right?
You could have, what blows people's minds is you could have two businesses side by side, same number of employees, same revenue, two totally different values.
You know what? I talk to people about that all the time because they're like, there's a competitor right across the street who does exactly what we do. And, I know that that's not the case. You own your building, they lease theirs. They're two brothers, you're a solo operator. They've got long-term contracts, you have short-term contracts. They're low profit, you're medium profit. There's so many variables that go into making up that value that from the outside driving down the street, you're like, yeah, they both do the same business, but they actually don't run the same because of 1,000 micro reasons.
100%. So like if you really boil down to the two main methods that a company of any kind, but certainly a construction company, you're going to be living in that market world we just hit on and an income approach world. The market approach one is a multiplication. It's a multiple typically of earnings of some form times, your earnings, right? The hard part is what you just hit on is, well, what multiple do you deserve given all of those factors that you talked about? And it's the same problem with the income approach. An income approach is kind of more like a division instead of a multiplication, where your numerator is cash flow. Think of that as earnings to keep the analogy the same. Well, the denominator is your risk and your rate of return. That's your discount rate. That discount rate is higher if you have more negative factors like you were like on things you talked about. And so the hard part with coming up with your sale price is you got to put yourself in the shoes of that buyer and start looking at your business with that lens and going, okay, where are they going to perceive risk? And that's what has the ability to lower or increase multiple for the one approach and lower or increase discount rate for the other approach.
It's funny that you took that line of logic and reasoning right there, because one of the things that I do when because I work one-on-one with clients, right, as a business coach, sometimes we get stuck in our coaching meetings. Sometimes the business owner's just in a place where they got too much to do and everything looks like it's too big to deal with. And I slow them down, and just a very simple exercise. on a piece of paper, write down what would happen if you bought this business today? What needs to happen immediately? And it's suddenly so clear to them. We need to fix this. We need to get rid of Georgie. Oh my God, he's a thorn in our side, right? And we need better clients, or we need a better piece of machinery. We need something. But it whatever their answer is, always becomes so clear. This is what we need to do if we were the buyer. And so I like that when you're talking about these approaches. What would the buyer expect when they came along to look for a company to buy? Because they've got choice too. Buyers have a lot of choice. They don't have to buy your company. So you might as well make yours look really good.
100%, and especially given just population dynamics in developed economies, that apply in many countries where we have kind of an aging population, and so there's this silver tsunami dynamic where over the next
tsunami.
5 to 10 years, you're going to have a lot of people that look like you in terms of type of company that are all selling at about the same time. So you want to look the best versus those peers, so you'll command the highest multiple no matter what's happening in markets, because markets are going to be outside of your control, right? The economy is going to go up and down, and that's what I tell people is in general, stock markets are moving up and to the right, but there's a lot of periods of things that look like Rocky Mountains where they're going up and down, and we just want to make sure you're in the best position in light framed in light, so that way you'll sell for the highest multiple and be perceived as a lower risk, no matter where things are from an economic or industry perspective.
Right. Yeah, because a buyer's looking for a deal, but they're also looking for an easy company to buy. And so if you're running with good systems, simple systems with predictability, if you know what your forecasts, like you can see with some degree of certainty what the business is going to be doing in the next couple of months or years, that's a comfortable business for people to buy, and it's a safe place for them to put their money. If you're running a risky business and you don't know your numbers and you don't have simple systems, that's too risky, and you're going to drive away the right buyer.
Totally agree.
Hey, so I want to make sure I've captured this right, David. So you outlined 3 different approaches to figuring out the value. And I know that these aren't cut and dry, because I'm sure you do combinations of there's always some intelligence that goes into it. But so far, we've got the cost or asset approach. We've got the multiple of earnings approach. That's number 2. And then what's the third one? Or have we talked about it yet?
Yeah, 2 is the market approach. And most often people are using some form of market multiples based on M&A transaction data. And then the third was an income approach.
Okay.
And typically you're using one of 2 methods, either a discounted cash flow methodology or a capitalization of earnings. Just listen to the word of the approach, right? Income, right? So
I gotta put on my dunce cap on this one. Sir, I have a question. What the heck is a discounted cash flow approach? I'm sure people are saying that right now. Can you please say that in English?
Yes. So in English, this is that division analogy I was giving you, right? We've got the buyer, right? If they hand you a pot of money, no matter what amount, their return comes from the earnings that this thing is going to kick off for them, right? That's how, for them, they're wondering, well, how long before I recoup my investment and get my return on my asset? And so what a discounted cash flow method, although sounds scary, all you're really doing is projecting picture a profit and loss statement. It's almost like you're projecting a P&L into the future. Yeah, you're going to have a few adjustments because earnings is not exactly what we call free cash flow. But a good starting point would be to forecast some type of income statement that has an estimate of earnings. And then we have to discount those earnings back to today. That's the discounted part in the word discounted cash flow.
Yeah. This is a description that I use to go after that, and tell me if I'm close or wrong, in which case I apologize to many people. When somebody comes to buy your business, they look at your business like a bank machine, like an ATM. They're going to buy that business, but they expect that ATM to kick cash out to them at a certain rate. And so if they pay you 2 times the earnings, they expect that over the next 2 years, that bank machine, the business that is your ATM, is going to kick out the money back to them. And the 3rd year, they're going to start to have their own profits back after paying you. Of course, they're super smart when they buy your business. They've got all the hopes and dreams in the world, and they think, you know what, I'm going to do it better than the other guy did. And I'm going to get my money back in a year and a half. So it's going to be a deal for me. Is that a pretty good way of explaining that discounted cash flow approach?
I think it's great. Yeah, you're inherently
Okay, so I don't have to go apologize to people.
Inherently, every buyer is going to have a time period from which they want to, recoup that purchase price, right? And we tend to see deals happen in this, anywhere from 2 to 6 world, which again is a giant range. But absolutely, it's a lot like the lottery. Like imagine you just won Mega Millions. You have a choice to make. Do I take the money now? And it's a much lower amount than what was advertised, right?
Right.
Or do I take an annuity over 20 odd years? A discounted cash flow is the analysis of assessing, well, what is that annuity of 200 grand for 20 years really worth? It's not as simple as just adding 200 grand over 20 years. We've got to discount that because a dollar today is worth more than a dollar tomorrow.
Yeah. Well, that's a really good analogy, the winning the Powerball and what that actually means. A lot of people don't know that you can take the money today, but if you won, just to use $1 million, if you won $1 million Powerball and you took the money today, you don't get $1 million, right?
No. Yeah, you're going to get a much, less, somewhere around half or somewhere.
Yeah. Well, then the government comes in and says, oh, by the way, don't forget about us.
Oh, they're always going to have their hand out, even with selling a business as well. So
yeah. Hey, so I've got 2 questions that came up through the notes I took, and if you don't mind, I'll ask you both, and then I'll let you sort the priority of them.
Sure.
These are questions I hear from business owners. These are construction contractors out there, and these are come from frustrations, right? One of them is, how come my net income is not the same as my take home? Like my net profit is not actually what I bring home at the end of the day. It's not cash in my jeans. I don't understand that. And then the other one is, you use the word fair market value earlier when you talked about 3 main approaches to figuring out the fair market value of my business. But the first thing that people say is, well, I don't want fair market value. I want more than fair market value because I'm special. I'm a snowflake. My hair is different. So I know that those 2 questions aren't necessarily in order, but I thought I'd put them on the table and let you figure out the priority.
I'd say let's start with the last one, just because of recency bias.
Yeah.
And then once we've done that, let's feel free. We can definitely go back to the first.
Sure.
So why we recommend valuations annually is not always to get to the exact dollar amount of like what's fair, although that is the goal with fair market value. It assumes a hypothetical seller and a hypothetical buyer, basically, as opposed to a specific. Really, the benefit of all of this isn't like, okay, hey, last year we did a valuation, our company was worth $1 million. We did one the following year, now it's 1.5. Because you're right. I mean, when we get to a specific buyer, someone actually in front of us, our goal is to get more than the 1.5 million, but it allows us to do 2 things. One, it gives you what's reasonably fair with the fact pattern that existed then, so you don't undersell potentially, right? So that's one big benefit. 2, just the discipline of doing this. It's really more important about that change in fair market value, because doing these assessments on this frequency and getting you to change your lens on this, transferable value, enterprise value mindset, that's really where the value comes, is because now we're going to be able to go to these buyers and show them the things that you've been changing and that have been moving or translating into your fair market value that then is going to start to sell the sizzle and hopefully drive the multiple up that this buyer is going to want to pay for you. Yeah. So those would be the 2 things I would cite why fair market value is A, important, and B, I agree. The goal would be that old commercial, when banks compete, you win, right? So we want to make as many buyers competing for you and wanting you as possible, and that way fair market value ends up being way lower than what you end up selling for. But again, it's all about that discipline and then finding out what is reasonable, assuming there wasn't competition like that, and you just have someone that landed in your lap. And again, the goal would still be to always try and get above that if we can. That's kind of the art of the deal. Yeah.
I've seen that used quite a bit, and more, I think, over the last few years than ever before. I've been coaching now for 23 years, and these kinds of conversations didn't necessarily come up in in the 90s as they have now, is people are using strategic planning and systems, like trying to put real solid systems in place in their business, because they know at some point they want to hand a working company to their kids or to their managers, or sell it to somebody on the street. But more and more people are recognizing, I can't just be selling a pile of barely working systems. I got to sell a little bundle of predictability, a working business. And so tools that you probably recognize, EOS system, Traction, or the Rockefeller Habits, or some other, you need some sort of operating system to run this business. So when the buyer comes and looks at you versus a painting company or a wood company or roofing framing company, they go, well, there's 4 companies in front of me I could buy, but this one here runs on systems. This one here has regular reports. This one here knows where they're going. This one here already knows their shortcomings and they're working to fix them. Why wouldn't we pay above fair market value for this one? And the other 3 guys who are for sale just keep going, well, yeah, we've had it on the market for a long time, but nobody's really interested. We keep getting low ball offers. Meanwhile, business number 1 is sold, gone.
I mean, you're preaching to the choir. Yeah. I mean, one of the common suggestions we'll make to help improve and amplify valuation is things you're hitting on, which is to be running on some type of business operating system. And we do regularly suggest systems like EOS and scaling up with Burn, and Pinnacle is kind of an offshoot. I mean, there are many. And that's where we go back to that side-by-side business example. And you're going to have one business that doesn't have the documented systems and isn't able to show, what they're trying to look like in 3 years from an org chart perspective and the vision. Whereas the business to their right has all of that. They look like a much more sophisticated seller and is going to be treated more accordingly from the buying community.
Yeah. So when you, in your experience, how do I get above fair market value? Because everybody listening is a little bit competitive. And when you hear the word fair market value, you're like, I want better than that. I don't want to be treated fair. It's my turn to sell. I want the most money. What are the kind of things that people listening can start to do in their business right now to get above fair market value?
So yeah, that's a great question. And I take that question as almost, what are factors that amplify my value, right?
Right. Yeah.
So, I mean, there are many, right? Profitability trend that you look like an up and to the right, on revenue and margin, right? Your margin percentage, right? And not just that it's, high, 20, 25% type margin. It's how are you versus your peers? Because we're going to be able to leverage databases and see how you relate with other construction companies. And so we want to make sure that you're at least at, or preferably above, if we're trying to get top multiple. Recurring revenue.
Oh, I love recurring revenue. Yeah.
Common topic where, again, you'll get higher, typically multiples being paid. A management team, meaning, one of the biggest negatives on company value is what we call key person risk, where the owner has not built out a sufficient upper middle management team to pull some of the load off that owner. And so there's significant risk where if something happens to the owner or they leave, that the value that the buyer thought they were going to be able to get goes away, because maybe the customer relationships follow that old owner and these kind of things.
All the systems and processes and know-how that's in one person's head.
Correct.
Yeah. Profitability, comparables of you. So sorry, let me repeat the title. Here are David Hern's quick ideas for getting more than fair market value when you sell your business, right? So here's the factors: profitability, comparables of you versus your competitors or your peers, recurring revenue, one of my favorites for sure, management team in place, any others?
So we're going to look at retention is what I would call, or attrition. And we're going to look at that in a number of places. Retention of customer relationships, retention of your team, like meaning that you have low turnover, right?
Right. Yeah.
So usually you've got to apply these concepts not just to your customers, but also your employees and even your vendors, right? And so a buyer is going to look at every one of those legs of the stool to see, is there concentration? And again, it's because it's all about risk. Okay, I buy you, you get all of your equipment from this one vendor. What happens if we're not able to get the equipment from that vendor anymore, right?
Yeah.
And am I going to need to incur more costs? So they're going to want to see that you have diversity or diversification across many avenues of your business.
Yeah. There's another one that's a real favorite of mine, which is real estate. And I know in some markets, it's very difficult to buy your real estate because if you're in Silicon Valley, if you're in New York, Toronto, Chicago, Vancouver, it's expensive to buy real estate. But what does owning the real estate do to the market valuation of a company?
Yeah, so this is a great question. Many times we'll see owners who choose to, like for example, with their office, right? Rather than just rent somewhere, they'll buy their property, and many times they'll put it in another entity and rent from themselves.
That's what you were talking about before. There's different companies. You've got a property management company that's actually your company, and yeah.
And there's tax advantages to do that. So, I would highly encourage, your listeners to seek, counsel from their accountant.
Yeah, we should throw that disclaimer in here. I'm not an accountant, and we are not giving financial or legal advice on this show.
Well, I am licensed, but I am 100% not giving tax advice on this show. That was my can't pass again joke. But yeah, no, I mean, typically, because again, put yourself in those buyers' shoes. Right? If I buy you and now I'm worried about my rent line, right? Is how predictable is that rent line, or is it about to move on me because you've gotten a sweetheart deal because you rent from family and they're giving you a below market rent? Well, they're not going to treat me that way. They're going to adjust it to market as soon as I take it over. Yeah. So, owning property is wonderful because of tax advantages. And again, many times we'll see sellers that'll sell their business, but then stay on as landlord to the.
I love that because you could sell your business twice.
Exactly. Yep. 100%.
Yeah. These are so, you realize you're running a brilliant podcast episode with me today, right?
I was going to ask at the end how we did.
Yeah, I think you're doing great. I've taken a lot of notes. I mean, that puts a lot of pressure on you that the rest of the interview has to go as well.
I mean, there's only one direction to go now, so I'm a little worried.
But people do worry about these things, because when we hear the word fair market, even if you don't know the word fair market value, the nature of being a business owner is we compete with ourselves internally. You want to do a little bit better than you did before. And if I want to pass this business on to my kids, I want to pass them something that's doing great. I don't want to pass them a jumbled heap of nothingness. And again, if I want to sell it to my management team, I'm proud of what I've built and I want them to do well. If I want to sell it to a guy off the street, I want him to pay me really great money so I can choose which property I get to retire on or do whatever I want next, or philanthropy or mission work. All that money is going to go to something else I care about a lot. So the factors that increase my my market value when I go to sell is obviously profitability, comparables, recurring revenue, which I just love. The management team, you can't have key person risk, retention of important elements of the business, customers, team, vendors, and then real estate. Wow.
I mean, if you start there, you are ahead of many, many of your peers. The statistics are very dire and negative, where the vast majority of companies don't sell, they attrite. Is the way I describe it, where there's just a moment where the owner's done and then you email them and there's an email bounce back. There's a close sign on the front door. Something like 80-90% of businesses don't sell, and it's because they don't take the time. They know they should do this stuff, but they're so busy running day to day, they never stop to plan for these things. And again, it's never just getting the plan exactly right. I mean, to me, the plan is like an architect. It's just a living, breathing document, and things are going to change as you bring in the various contractors to do all the different components of what the architect designed. But it's that discipline of doing a plan and making, like to your point, 1% improvements a day, it adds up to big numbers over time.
Yeah. Earlier in today's show, you mentioned Vern Harnish. I'm a big fan of Vern Harnish. I mean, I used his original plan, which is the Rockefeller Habit System. Now that book was rewritten into Scaling Up. Fantastic operating system. But one of the things that he says in Scaling Up is most companies don't die of starvation, they die of indigestion. which goes to what you're saying. It's that jumbled up, frustrated, I'm scattered, I'm dealing with the same 5 problems every single day, just different flavor every day. And that is what ultimately drives people nuts about owning a business. But when it's the hard part, I guess, to understand when you're not in it is it's easy to fix if you just focus on, like you said, what are the things that are going to give the most value? What's going to make the business run a little bit smoother every day, just 1% at a time. Every time you get up to bat, which is every day, just hit a single. I mention to people all the time, if you made one small change in the business every week and you committed to doing it, it doesn't sound like much this week. Oh, what's the one thing I could do? We could change the way we intake new customers and have a form that everybody we fill in. I'll use a very simple paper-based system. Well, if you made a little tiny change like that every week, that'd be 52 small changes in a year. Well, now we've got that analogy you used earlier of 2 companies across the street from each other that look like they do exactly the same thing. Let's say they're both in roofing or cabinets. Well, the company on the left-hand side of the street makes 52 small changes this year. The company on the right-hand side of the street doesn't make any at all. What's going to happen to the valuation of the company on the left? You don't have to be smart to figure it's just going to go up. They're going to get a little bit better every time.
Right.
Yeah.
That's what I try and instill in my kids is 1.01, 1% to the power of 365. It's a very big number.
It just keeps growing.
And, a lot of people try and they go straight down into the tactics, like with some of them we talked about from, diversification and, recurring revenue and management team and so on. But I think there's some easy ones. One you hit on, which is, every business should be running on some type of operating system, like you've talked about with Vern and so on in the US and so on. Another is, are you in a mastermind group, which is one of our diligence questions, a CEO mastermind group. You need to be in a room, and they don't all have to be in your space. It's amazing how much you can learn from other types of companies.
That's how you and I know each other, because we know each other through an entrepreneurial mastermind group.
We find some of the companies that sell for the highest multiple, their key executives are part of some type of mastermind group where they're sharing things and problems in their business, and they're learning from other peers, because the top is a lonely place, as you and I know, and so that's another very common, beyond just the system, that operating system. We also suggest they be part of a mastermind group where they can go to people with their issues.
Yeah. Now, one of the things that's really common in our industry, because we're in the construction trades in general, everybody's got a different trade. There's some are residential, some are commercial. The commercial guys are split into regular commercial work or civil or institutional, but there's industry associations out there. And one of the things that I've recognized over my years of coaching is that most of the people that I work with are already part of an industry association, because they're all kind of facing that same direction. They've gotten out of the being in the shop or on the job site, and they go, there's a bigger world out there. I need to start hanging out with people asking bigger questions and see how other people have dealt with the same problems. And so I love that you said that. Mastermind groups is one thing. Industry associations, would it be fair to put that in the same category?
I would agree. Yeah, they're great because we've seen some where they'll do some of this benchmarking for free as part of their members, where it's, they're going to anonymize who everybody is, but they'll show you a curve of, based on your size and profitability, where do you fit versus everyone else of our members. And then, it's some really good benchmarking. Not every industry group does that, but the ones that we've seen that do that, it's really a good benefit for their group members.
Yeah. I just reviewed one. It got sent to me the other day, well, a couple of weeks ago. The AWI, which is the Architectural Woodwork Institute, does an annual cost of doing business survey. You have to be a certain kind of person to find excitement in those reports, but I guess I'm that kind of person. But yeah, there's various other industry associations that do that. And you'd never be able to call your competitor, again, right across the street, and say, hey, what are your gross margins? How much as a percentage of labor are how much of your revenue is labor as a percentage of revenue? They'd never answer it. And they probably don't know. But then in your industry associations, they have reports like this, and you'd look at it and you go, oh, their number is 7%, we're at 9%. Is that good or bad? Because it doesn't necessarily, a higher number or lower number doesn't necessarily mean anything. it's all in context. But yeah,
Sure.
you have to know what's going on in the zoo, or you're just not going to be, you're not going to be at the top of your game, and you're not going to get that double tick mark on your price.
Agreed. Yeah. So again, I highly would suggest, yeah, if you're not taking full advantage of your industry group, start there. And then if you're ready to take an additional step and be in kind of some closed rooms, with full NDA protection and mindset, it's amazing to see executives sharing, issues that are going on in their business and learning from each other on how people are handling things like, how do I make time to work on these things when I'm running 100 different directions?
Yeah. Time management.
Sure.
Don't get me started on time management.
And delegation.
Yeah, and delegation. And well, it really, it all comes back to the operating systems you're talking about. And I know I talked about Vern Harnish's scaling out, but I've been a big fan of the EOS system for a long time now as well. That's the one I use a lot. Is it okay if we switch gears to that second question?
Sure. I may need a refresher.
Yeah, that's okay. Fair enough. I'm taking a lot of notes here. So you know how you've got gross profit. We're trying to get our gross profits up, gross profit margin. And then, we remove some other expenses. Then we've got our net profit. But sometimes people will say to me, well, how come net profit says, or my accountant says we made $200,000 last year? I didn't bring $200,000 to my kitchen table. Right. So how does a valuation based on net profits not translate into I'm not actually taking that cash out?
So yeah, great question. There's a lot of different topics we can talk about in there. To start, there's a concept called seller discretionary earnings, is the phrase, SDE.
Yeah.
And for me, to make it as simple as possible, to me, it's that net earnings you were talking about, roughly, plus your salary, right? It's earnings you as the owner, it's money you as the owner have some control over, right? You have the ability to change your pay, high or low, like salary pay, base pay, and bonus. And then, whatever's left over, in theory, that's distributable cash. But to your point, sometimes, there's not as much there to take out. To me, there's a whole nother concept of what's called working capital. And so, yeah, your business inherently, you can't just distribute all the money, or you can't fund ongoing operations. So there's an element of a percentage of cash. We look at it as a percentage of revenue across companies, but of net working capital that you've got to leave in the business that really isn't what we call free cash flow. It isn't free and clear, and you've got to have room to buy CapEx and do things of that nature before you have cash that you can truly just distribute.
Spend. Yeah. Yeah. It's always so crazy because you look at it and the accountant says I made 200 grand last year, but I didn't see it. And it's because it goes into other things, right? And like, I think you mentioned this earlier, there's a couple ways of doing the books. When we do the books, we're usually doing it to keep our taxes low. We're not doing the books to try to get the maximum valuation on our business, or I don't know, something else, qualify for loans to buy that real estate. There's little adjustments guys like you really know how to do.
Here's a great example, right? We may see, salaries, we'll see people underpay themselves on salary. They'll pay themselves 40, 60 grand based on their accountant's advice.
Yeah.
They're typically structured as a pass-through entity. So really, they don't want to pay FICA, and they want to maximize distributions because they're trying to save some percentage of their money and push everything to be distributions. Problem is, when I buy you, 40 grand for the CEO is not really a fair market salary. So we've got to raise that when you don't have to change anything in your books, but me as the buyer, when I do my projection, that projected P&L, I'm not using 40 grand. I'm going to be using something much bigger, and I'm going to run peer analysis of other construction firms. I'm going to see, oh no, the average CEO is making a lot more than 40 grand. Same thing with the rent. Again, we talked about that earlier with the below market rent. So that's the kind of look they're going to have on all your expenses to see, when I inherit the business, what stays the same and what moves up or down. And there is some down, right? Because maybe the buyer's a lot bigger, and so they're able to squeeze synergies through insurance or redundant accounting.
Replace the accounting. They've got their own bookkeeper or IT person. You don't need double up there. Hey, that's a good question. Let's use that 40,000. The president's taking $40,000, but the market rate is $100,000, and both of those numbers are ludicrous. Let's just agree right now. Those are not good numbers. But let's use them as an example. Can I pay myself at the $100,000 rate, but on the books only take 40, leaving that 60 as a note to myself, as a credit note to myself, so that when the business sells, it says, well, the owner still owed that $60,000 shortfall every year.
So this is getting close to the line of kind of accounting advice. I would tend to
Am I
steer you
asking for too much here? Because
to
that's
them.
just my
I don't
style.
foresee an issue with that. All the buyers are going to vet is like in that case, because you mentioned a note, right? Is they're going to ask themselves, well, is that note real? Does that need to be paid? And then they're going to factor that in, whether it's an asset or a liability. Where they have heartburn is when there's things on the books that really aren't true and there, or things that are off the books. I mean, nothing will scare a buyer like some kind of unforeseen liability. We've seen some where there's a lawsuit, and there's a chance that, there's some small settlement amount, but there's no liability on the books for any settlement amount, right? Those are the, things. So there aren't always things on the books. There's things that are off the books too, that our buyers are going to want to make sure they have a full grasp of as well.
Yeah. Yeah, I know that I've seen the situation myself where let's use the $100,000, what you're supposed to get, 40,000 is what you're taking. So you've got that 60 grand that's banked.
Sure.
Of course, when the buyer comes along, they're going to say, well, I see here that you're owed 60 grand for the past couple of years. Yeah, we're not going to pay you that. However, we are going to pay you 20 of that. So it's still a little nudge. You see, I like to try. I'm working for people here. I'm trying to get what I can. But if it's not on the books at all, there's no discussion to be had. Sure. You're just taking 40 grand, and the new owner comes in and goes, well, that's not market rate. When I replace you as president or GM, I'm going to have to hire somebody, and he or she's going to make 100,000. So thank you. But you still didn't have that number in there to be negotiated in the sale. So I don't know.
There's going to be, everything's a negotiation, right? So, every purchase agreement is going to have an excluded assets section. For example, we see a lot of owners that, they bought maybe a big truck through the business because they were able to, deduct the whole thing through. And then they really use it also for personally. And so, there's agreements like, okay, no, you can take that with you when you go, those kind of things. So line by line, every line on your P&L and your balance sheet are going to be scrutinized. And, but as you get closer to your exit horizon, which I think should be a 3 to 5 year timetable. Some people wait a little longer than that. That's when you want to start getting your books cleaner and cleaner and cleaner. So by the time buyers are in your door, there's no funny business, and they're viewing you in kind of a low risk life.
Are you saying that I don't just put my business for sale today and it sells tomorrow and I get the check on Monday? Is that what you're saying?
It would depend on the price. But if it's the price that I think that you're going to want, I would just tell you Google average length of business sale, and it's going to probably scare you with how many months the average business takes to sell. And it's because a lot of them do that. They have a expectation of price in their head, either that they came up with or they heard the rule of thumb, and so there's some, or that's just the number that they'll sell for. It's not based on anything. Yeah. And sometimes those are lucky and that's in the realm, and other times, they're overinflating, their baby's beautiful, whether their baby's beautiful.
Yeah. Ugly baby syndrome.
Yeah.
Yeah. Hey, this has been an excellent episode.
Thank you.
Yeah.
You've been an excellent host.
Well, thank you. You can see that I've been through this side, the buyer and seller side of the conversation a lot, not the valuations. The valuation is not my expertise. I know the things that help people get above fair market value. And you outline them so nicely. I'll probably say them in the outro again, but if you want above fair market value, your profitability's got to be there. You're going to get judged against your competitors, recurring revenue, management team, retention of key components of the business, real estate, and be involved in some sort of outside, have some outside perspective brought into your company, masterminds, industry associations. I know this sounds self-serving, but working with a coach who's there to guide you, like all of those things, they all add to the story so that when the next buyer comes along, this looks like an easy business to buy, a safe place to put their money, and a guaranteed return in the future. That's all they want.
Your comment about the coach is we didn't harp on this enough, but having a team of advisors around you, it's almost like a president with their cabinet. The sellers that we see that have people that haven't just done this once, that have done a lot of M&A and amplification of value. While there is a cost to all these different advisors, coach, valuation consultant, attorney, accountant, financial advisor, so on, right? There's a good 6, 7, 8 different people around you. Those tend to do a few things. It amplifies valuation. It increases your probability of sale, which to me is underloved. On again, the numbers stack against a lot of firms. So it takes some investment in surrounding yourself with a team that you'll listen to, and work with in order to extract what you really want for your next chapter.
I'm happy to talk more about the coaching thing because that's my world. But I remember a roofing company in Texas that when the company sold, the business coach was contracted into the new buyer because they felt that was an important part of the retention of the IP. When the owner was going to leave, they wanted his business coach to be working with the new owner, which I thought was actually, I'd never heard of that before, but it was a really smart way to go.
That's awesome. More often I feel like you see where the buyer has so much hubris. They're like, we'll use our people. So, that says a ton about that coach, that they were able to show the buyers, just how much value they add and institutional knowledge. So yeah, I'm really impressed by that.
Yeah. Such a good episode. Thank you. It's answered a lot of questions. It probably opened up more questions as well. If somebody wants to find you, how the heck do we do that?
Yeah, no, great. Obviously, please feel free to send me an email. My email is david@soferadvisors.com. That's SOFER advisors.com. And I have a great presentation of slides that talk and show visuals of a lot of the concepts we've talked about. Happy to give that away. We always have free consult. Always happy to be a resource for you, Dom, and for any of your listeners and any of your family and friends.
I love it. Well, thank you for being on the show. You may have earned yourself the dubious honor of getting called back again in the future for some other discussion, but I think it's been fantastic. I really do. And I appreciate you sharing your insight. And of course, working with my client on that family transfer. I appreciate that as well. Here's something people don't know about you. Can I share it?
Go for it. I'm a little nervous.
Well, you're going to look pretty good in this. I went to that entrepreneur networking group that you and I are both in, right? Because we're in a mastermind ultimately. And I said, hey, I need a business valuations person who understands this market, And a whole bunch of people in that chat group said your name. And I'm like, these must all be his cousins. Like everybody's like, you got to talk to David Hern. You got to talk to David Hern. And, I got some other names in there. Some people I know, a few had already been guests on my show. So a few of the names I got back had been guests on the show previously, but yours I'd never heard. And I'm like, well, who's this David Hern guy? Like, how come I don't know who he is, but everybody else does. So to your credit and congratulations, you have a lot of fans out there. So thank you for coming on our show.
Thank you. Yeah. I mean, it's probably the single greatest thing I built before launching my business was to build we call it a COA, a community of advocates. And we're very humbled to obviously be increasing that community. And I love how small the world gets when people pull you to other folks. So
yeah,
it's good to meet you, Dom. Thank you again. And my pleasure for being here.
Thanks. Okay. We'll see you again. Thanks, David.
All right, Dom.
Okay. Bye-bye. Well. Let me start off by saying thank you to Mr. Hern for joining us. I've actually got a couple of dad jokes set aside just for this purpose. They're going to be accountant jokes. And David, please don't take it personally, but they are aimed directly at you. No, I'm joking. I really appreciate you giving us insights into valuation, especially for construction business owners. Typically, that's not discussed in our industry, and I'm happy to be the one that brings that. The reason we do dad jokes here is very specific. And I want you to think about a situation that maybe has happened to you. Why don't you think about you in the shower? I know some of you are like, oh, where's he going with this? But think about that day you get soap in your eyes and your eyes are burning and you can't see. Now, you've been in your shower a million times, but what do? You start fumbling around and you can't figure out where the door is, even though you've reached that door handle a million times. That's what it's like when you go into trying to learn about business with your eyes closed or your eyes not working. You don't have clarity. And so the reason I tell the dad jokes is there's a reason behind everything I do on this show. That's why I'm a business coach, because I think about these things and I think about the outcomes and I think about, this is going to sound very dorky, but adult learning principles, one of which is based on manageable chunks. Another one's based on reality, not theory. There's 5 of them, but I'm not going to get into that here. So I want you to understand, I do the dad jokes because I want you to have an open mind, just like I want you to have open eyes. So you don't stub your toe in the shower, right? So you don't fall down. So when I tell the dad jokes, it's so that you can open your eyes to the possibility in front of you. Because today, right after the dad jokes, we're going to dissect a common business problem. Actually, the business problem is blind spots. How do we find those blind spots in your business? You have to ask some specific questions, and I'll walk you through a few of them here. But first, let me get to what I promised. Mr. David Hern, you inspired me to find some dad jokes that have to relate to accounting, and one of them is particularly spicy. Hey, do you know there's 3 types of accountants? There are those who can count and those who can't. I know you're waiting for more. And by the way, this is the mind worm that I've put in some of your heads because you won't be able to sleep tonight because there's an answer missing in that joke and it's driving you bonkers right now, all on purpose. So there was this accountant. This is a joke you can tell. You can actually tell it to your bookkeeper or your accountant at work. There's this accountant and she was having difficulty getting to sleep at night. So she went to see her doctor. And the doctor said, have you tried counting sheep? And she goes, yeah, that's the problem. When I make a mistake, I spend 6 hours trying to find it. Wah, wah, wah. All right. This one here is oh so good. And I think you're going to like it. Did you hear about the constipated accountant? He had a ton of paperwork to do, but no matter how hard he tried, he couldn't budget. So he decided to work it out with a pencil.